Are you someone who wants to grow your money, to build a more secure future, but feels like the world of investing is a private club you weren't invited to? Do words like equities, portfolios, and market volatility make your head spin? You're not alone. Many people feel overwhelmed thinking you need a finance degree or a huge pile of cash to even get started. But I'm here to tell you that's simply not true. The truth is, investing is a powerful tool for everyone. In this guide, we're going to demystify it all. We'll cut through the jargon and break down the absolute essentials in a way that's simple and clear. By the end, you'll not only understand the basics, but you'll also feel confident enough to take your first step. So let's start with the why. Why not just keep your money safe in a savings account? It's a fair question. A bank account feels secure. But there's a silent force at work called inflation. Imagine a coffee costs $3 today. With steady inflation, that same coffee could cost much more in 10 years. The $3 you saved won't have the same purchasing power. This is why saving alone isn't enough for long-term goals. Now, for the magic of investing, compound interest. It's when you earn returns not just on your original money, but also on the returns you've already made. It's like that snowball rolling downhill, getting bigger and bigger at an accelerating rate. This is how your money truly starts working for you, powering you toward your biggest financial goals, whether that's a down payment on a home, funding education, or ensuring you can retire with freedom. So, where can you put your money to work? Let's look at the main options. First, stocks. When you buy a stock, you're buying a tiny piece of ownership in a company. If the company does well, its value can increase, and so does the value of your share. Stocks offer the potential for high growth, but they come with higher risk because their prices can be volatile, going up and down dramatically. Next, we have bonds. Think of a bond as an IOU. You are lending money to an entity, like a corporation or a government. In return, they promise to pay you back in full on a specific date, and along the way, they pay you regular interest. Bonds are generally considered safer than stocks, but typically offer lower returns, adding stability to your investment mix. Finally, and this is a fantastic starting point for beginners, we have mutual funds and ETFs. Imagine trying to buy a little bit of hundreds of companies. That's what a fund does for you. It pools money from many investors to buy a wide variety of investments, a big basket of different stocks and bonds. This automatically diversifies your investment, which is the key to managing risk. You've heard, don't put all your eggs in one basket? Funds are like buying a pre-made diversified basket. ETFs are very similar but trade on an exchange just like a stock, making them very flexible. Feeling ready to begin? Here's a simple step-by-step plan. First, open an investment account through a brokerage firm. Think of it as a marketplace for investments. Many user-friendly online brokerages and apps are perfect for beginners, often with no minimum deposit. Second, fund your account. Connect your bank and transfer some money over. Remember, you can start small. Whether it's $50 or $10, the most important thing is to begin. Many platforms even allow for fractional shares, so you can own a piece of a big company for just a few dollars. Third, choose your first investment. For most beginners, a great choice is a low-cost index fund or ETF. An index fund doesn't try to pick winners, it just owns a small piece of an entire market segment like the S&P 500. It's instantly diversified and simple. Finally, the secret sauce, automate it. Set up a recurring investment every week or month. This builds discipline, removes emotion, and allows you to buy consistently, whether the market is high or low. It's a powerful way to build wealth steadily over time. Finally, let's talk about the right mindset. Investing is as much about psychology as it is about numbers. Here are 3 golden rules. Rule 1. Think long-term. Investing is not a get-rich-quick scheme. The market will have ups and downs. Don't panic during downturns. History shows that markets trend upward over long periods. Your greatest ally is time. Rule 2. Diversify. We've said it before, but it's critical. Don't bet your future on a single company. Spreading your money across many investments reduces your risk. Rule 3. Be consistent. Consistency is more important than trying to time the market. A steady, disciplined approach almost always wins. Remember, the journey of 1,000 miles begins with a single step. The best time to start investing was yesterday. The second best time is right now. Your future self will thank you for starting. Don't wait for the perfect moment. Start small, start simple, but most importantly, start now.
Welcome back. In part 1, we laid the groundwork, why investing matters, the main investment types, and how to get started. Now we move from theory to action. In this part, we're diving into the most important step, how to choose the right investments for. This is where many beginners get stuck, so we'll focus on building a clear, simple strategy that cuts through the noise and sets you on a path to success. So, what's the one best investment? The truth is, it doesn't exist. Think of it like choosing a car. A sports car is thrilling, but a terrible choice for a family of 5. Your financial journey is just as personal. The perfect investment strategy isn't something you find, it's something you build, tailored specifically to your life. That strategy is built on 2 cornerstones. First, your financial goals. Are you saving for a down payment in 5 years or retirement in 30? Your timeline is critical. Short-term goals require safer investments to protect your principal. Long-term goals, however, give you the runway to take on more risk for potentially greater growth over time. The second cornerstone is your personal risk tolerance, your emotional and financial ability to handle market swings. How would you feel if your portfolio dropped significantly? Would you panic or stay the course? Being honest about your comfort level with volatility is key to creating a portfolio you can stick with, preventing emotional decisions that can hurt your returns. Your answers guide your asset allocation, your mix of investments. With a long time horizon and higher risk tolerance, you'll lean towards stocks or equity index funds for their growth potential. If you prioritize safety, you'll lean more towards bonds for their stability. They act as a shock absorber. For most investors, the magic is in finding the right balance of both. For example, a younger investor might choose an 80% stock index fund and 20% bond fund allocation. It's simple, low cost, and diversified. Someone closer to retirement might choose a more conservative 60-40th split. The key takeaway is this: your portfolio should be a direct reflection of your personal goals and risk profile. It's your strategy for your future. Many beginners lose money, not because investing is a rigged game, but because they fall into a few predictable and avoidable traps. These classic mistakes can derail your financial journey before it starts. But by simply being aware of them, you're already halfway to building a successful, long-term strategy. The first trap is chasing quick profits, fueled by social media hype and FOMO. You see a stock trending and jump in. But by the time an investment is popular, you're often buying at the peak, just before a correction. This turns a hot tip into a painful loss. Next is trying to time the market, predicting exact highs and lows. It's nearly impossible. Even professionals fail at this consistently. Missing just a few of the market's best days can cripple your returns. The key isn't the market, it's the market. A critical mistake is investing without an emergency fund. This is your safety net, 3 to 6 months of living expenses in savings. Without it, an unexpected bill could force you to sell your investments at the worst time, locking in losses. Build your financial foundation first. So, how do you avoid these traps? The most effective plan is the simplest. Here's a straightforward strategy that puts you on solid ground. First, open an account on a trusted, low-cost platform. Second, start with a broad market index fund for instant diversification across hundreds of companies. Third, automate your investing with regular monthly deposits. This removes emotion. Finally, always reinvest your returns and dividends to accelerate growth. This consistent approach unleashes the magic of compounding. Your money earns returns, and then those returns earn their own returns. The goal isn't to get rich quick, it's to build wealth slowly and safely. With patience and discipline, you let time do the heavy lifting, creating lasting financial security. You've built a powerful foundation. You now understand the core principles of how to choose investments that align with your values and risk tolerance. Crucially, you're also aware of the common mistakes that trip up new investors, which will help you navigate the markets with more confidence. We've even equipped you with a simple, effective strategy to get you started on your journey. This knowledge alone puts you ahead of the curve, but your journey to financial mastery is just getting started. In our next section, we'll dive even deeper. We'll explore how taxes can impact your returns and what you can do to be more tax efficient. We'll guide you through setting clear, realistic financial goals, because knowing your why is the most powerful motivator. We'll also introduce powerful techniques like dollar cost averaging to help you invest consistently and manage market volatility. This is where we turn your foundational knowledge into a sophisticated long-term plan. That's what we'll cover in Part 3.